Three cheap stocks trading near their 52-week low. I think this is a good time in general in this market to start looking at stocks, maybe hated stocks that are cheap, trading near their 52-week lows, especially with a lot of the euphoria that we have in a lot of the growth stocks and the tech stocks. I think it would not be a bad idea to diversify away into healthcare, into maybe consumer staples, into a lot of sectors that haven't been doing too well this year. This is a good way, I believe, to diversify away from tech and be maybe better positioned once the tech rally potentially pulls back. So I'm going to talk about three interesting stocks today trading near their 52-week lows. A lot of you guys have asked me about those stocks, so I'm going to talk about them. And I really hope you enjoy it as always. Now, the first one, which was a highly requested stock, is PayPal, and I'm talking about PayPal again as my last video got removed for certain reasons, but PayPal is down 61% over the last 5 years. They say the longer the base, the more the upside, and the base on PayPal has been forming since 2022, and I think it's not gonna be like that forever, and there's gonna come a time where PayPal will potentially do maybe an Alibaba or some kind of a Chinese stock like move, because the sentiment is so bad, and the fundamentals don't reflect the bad sentiment that investors have around the stock. Now, if you look at the total active accounts, which is very important, they have been growing 2 million every quarter from 429, 432, 34, 36, 38. So 2 million new active accounts are coming into PayPal every single quarter. This is not a sign of a dying company at all. If you look at total payment volume, which is very interesting with this business model, it's very important. It has been growing at a 15% CAGR. This is not an indication that PayPal is a dying company. There's nothing that is showing me that PayPal is a dying company. Even Venmo growth is reaccelerating from 8% to 10% to 12%. So Venmo is also doing too well. In fact, the only thing that's dying about PayPal is their shares outstanding, because the company is buying back so much stock like there's no tomorrow. I mean, from 1.1 now is at 969, and they keep taking it down, and they can buy back a lot of shares because the free cash flow yield is high and they don't have any dividend obligations. So they have a green light to buy back as much stock as they can, and they're doing that, and they're ultimately going to create value for shareholders. Now, the only thing that's bad about PayPal is the revenue growth was decelerating from 9%, 8%, 5%, 4% to 1%, but it has recently reaccelerated. Now, the main reason why PayPal's revenue growth was decelerating is because of the Braintree side of the business. It was slowing down in revenue growth, and now it's picking back up. Now, the reason why it was slowing down in revenue growth was because the CEO was mainly focused on profitable growth. So they had a lot of contracts at very low fixed prices, and it was very low margins for the company. So they canceled out a lot of them, did a lot of things, but now it reaccelerated, and PayPal expects the growth of Braintree to reaccelerate in a major way in Q3, Q4. So the revenue decline in terms of growth days, I believe they are likely behind us. And something that's very interesting with PayPal is they scored a partnership with Google, where PayPal has a multi-year partnership with Google that will see the payment giant using Google's AI technology to create a new AI-powered shopping experiences. The company did not detail what specific types of agentic shopping experiences they would work together to create, but they said Google would contribute its AI technology and expertise, and PayPal would leverage its global payment infrastructure, personalization, and identity solution. Now, that sounds amazing, but for us to have a little bit more about the potential details of the partnership or how it could look like, we can look at PayPal's recent partnership with Perplexity, which is pretty much likely going to be the same thing. And I said, starting this summer in the US, consumers can check out instantly with PayPal or Venmo whenever they ask Perplexity to find products, book travel, or buy tickets. And I believe it will likely be the same thing between Google's Gemini platform and the PayPal platform, where PayPal has access to over 450 million monthly active users for Gemini. And whenever you ask the AI agent, you want to book a trip, you want to do something, you have the option to pay with PayPal. And I believe this is huge for a company like PayPal. Now, in terms of the guidance of the company, they expect $6 to $7 billion in free cash flow. And I believe this is achievable as the company has been beating on their free cash flow estimates. And they did raise guidance, by the way, which was very nice from the company. Now, 6 to 7 million of cash flow, we can take in the higher number of 7 billion. And out of it, we're going to take out stock-based compensation for us to determine the net free cash flow that they can actually use to affect shares outstanding and they can use to buy back stock. So they have around 1.1 billion in stock-based compensation over the last 12 months, which has been declining over the years. And this is very nice to see. So if you want to round it up, we have 7 billion in free cash flow. We take out 1 billion in stock-based compensation. We have $6 billion in net free cash flow that they can use to buy back stock. The company's market cap is around 62 billion right now. So this is around a 10% free cash flow yield. So PayPal is trading around a 10% net free cash flow yield that the company can use to buy back stock and do many different things. And you can buy back 10% of the market cap every single year, which is amazing. Now, whenever I value such stocks with slow revenue growth, I use free cash flow plus revenue growth. So free cash flow is 10%. Revenue growth could be 5 to 6%. Let's say 5% on average. This is likely a 15% annual return on a company like PayPal, excluding a margin expansion, excluding any potential initiative. I'm seeing a minimum of 15% annual return or a double over the next 5 years, again, without a multiple expansion or anything. So I believe PayPal is looking very attractive here, especially relative to the market. And it's really shocking that the stock continues to go down. I mean, it's really crazy. And I'm not seeing any justifications for that. Maybe in 2021, 2022, you could have justified it. But right now, I am not seeing anything that's justifying PayPal trading at such a low valuation. And I believe it remains a very attractive investment in this market. And by the way, I'm using Fiscal.AI to come up with all those charts. So if you want to try it out, they give you 2 weeks of free access if you use my link down into the description. Now, the second one, which was also a highly requested stock, is Bristol Myers. And this is because I talked about it last year and I said it was a good buy. And the stock did really well. And since then, it went up like 47% in a few months. And recently, it's been going back down. So BMY is an interesting one. It's trading at 7 times earnings. The stock has always been cheap. It trades at 8 times, 9 times, 10 times. Now it's trading at 7 times earnings, which in my opinion is very interesting. Now, the biggest problem with BMY is they never have like a solid pipeline, but they have a lot of those, like they do a lot of acquisitions and they keep acquiring new companies to offset the legacy drugs whenever the patent gets close to expiring. And over the next few years, they have a major patent cliff where they have a lot of legacy drug like Revlimid, which expires in 2025, Eliquis, which is a popular one, it expires in 2027 to 2029, and Opdivo expires in 2028, and those will affect the revenue of BMY in a major way. And in fact, they are already affecting the revenues. If you look at the legacy portfolio, it has declined from 6.6 billion to 5.7 billion, but they have the growth portfolio, which allows the acquisitions that they did over the last few years. And the company does so many acquisitions. It grew 18% year on year, which is pretty much more than offset the decline in the legacy portfolio. So I would not expect any growth in BMY, free cash flow, or even revenues over the next few years. I expect the new acquisitions to offset the old acquisitions at least for until 2028. And then maybe by 2033, 2034, we would be close to another patent cliff, and then they're going to have to do acquisitions again to offset them. And this is the business model of BMY. It's a special one. And in terms of the balance sheet, the company has around $14 billion in cash, so they can still do acquisitions, but they have around $49 billion of total debt, which may seem like a lot of debt, and the company is paying it off. But I don't believe it's a concern because the company has around, I mean, even if you counts the decline, around $13 billion in free cash flow. They're paying around $5 billion in dividends. So after the dividend obligation, they have more than $8 billion every single year for them to do buybacks, for them maybe to increase the dividend, or for them to pay the $49 billion in that balance, or to do even more acquisitions. So the company is very well positioned in terms of the free cash flow profile. I believe it will likely sustain itself around 13 billion. So I believe, the debt is not such a concern. Now, if you look at the company's dividends, they have a 5.2% dividend, 5.4 actually, and I believe it's sustainable as the company's free cash flow yield is almost 15%. And the average has been around 12%, 11%, 10%. 10% is normally fair for a company that's not growing too much in revenues. But this one is trading at a 14.6% free cash flow yield, and the 5.4% dividend is more than covered with BMY, which is a good plus. Now, in terms of an expected return, I would expect something pretty close to the free cash flow yield of 14 to 15%, as the new drugs will offset the older drugs. And this is, again, without a multiple expansion. But BMY has had multiple expansions in the past where it went down to 12%, 11% free cash flow yield, and now it's trading around a 14%. And you're also getting a 5.4% dividend while you wait for the thesis to play out around the new drugs and for more potential acquisitions. And the company is actually very good in terms of acquisitions. They don't overpay, and they do a good job at doing a lot of those acquisitions. So I like BMY over here. Maybe not as much as PayPal, because BMY still has risks around tariffs, risks around the new administration wanting to lower drug prices. But I think the stock is undervalued relative to their oncology portfolio, which they have a lot of key oncology drugs, and this is going to be a major tailwind over the next 5 to 10 years. So BMY, in my opinion, is very interesting. Now, the last one is Target, and Target is by far the worst one, and I've never been a fan of the stock or the company or even the store in general. I mean, I never liked Target in general, but it's trading at 11 times earnings. So I've been getting a lot of arguments if it's now a good time to buy Target because it's cheap, and it has always been cheap and always looked like a good time to buy. But the stock keeps getting cheaper, and that's why I said the stock was a trap. Now, on the last quarter, they actually did well in terms of earnings per share, and they also beat on revenues, so it was a decent quarter. If you look at Target's revenue growth, or I should say comp sales has been in the negative since 2023. They had some good comp sales whenever people had money from stimulus checks to spend on TVs and a lot of the electronics that Target is famous for. But now, again, it's been in decline since 2023, and it's been terrible. Now, the biggest problem with Target is mainly their revenue mix. Now, they made $24.7 billion in sales. Out of the 24 billion in merchandise sales, 4 billion comes from apparel and accessories, things you can buy online. You don't need to go to Target to get that stuff. Hard lines, which is a lot of, you could say electronic kind of stuff, $3.5 billion. Home furnishing and decor, this is extremely cyclical. This is around $3.6 billion. So if you add up all those together, it's around, I believe, 11 or $12 billion in discretionary spending. It makes up the $24.7 billion merchandise sales pie. Only 5.5 billion is food. 5.5 out of 24 is food, and the rest is mainly, you could argue that it's not too essential for customers compared to Walmart. Walmart has a much higher share of food and beverage, but Target has always been a store for discretionary spending, and maybe beauty is an essential one, you could say, but again, a lot of people buy them online. You don't need to go to Target to do that stuff. So again, I'm not a big fan of the business model or the store in general. Now, the company has a 5% dividend yield, and the dividend yield is sustainable because the free cash flow yield is around 7.3%. So it's not as good as Bristol Myers, of course, but I believe it's pretty well covered, and they're going to have around 2.5% left to do buybacks. And Target has been doing buybacks over the last few years, not much recently, but they have some power for them to do buybacks at this price. Now, again, I'm looking at free cash flow yield plus revenue growth. Free cash flow yield on this one is around a 7% free cash flow yield without too much stock-based compensation. So I'm using the 7% free cash flow yield. Revenue growth is pretty much non-existent. It has been declining in revenues since 2024. and is expected to rebound to 2.5%. This is nothing. PayPal is growing 6%, and Target is only growing 2.5%. So again, 7% free cash yield, 2.5% revenue growth, assuming no margin expansion, no multiple expansion. I see a 9.5%, 10% annual return. So maybe Target is good for the dividend if you're looking for a 5% dividend, but I really still don't like it. I still believe it's a trap, and I still believe there's way better opportunities in this market. So my favorite one is PayPal, then Bristol Myers, then Target. So thank you for watching. Hope you enjoyed it. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.